Yes, good morning, good afternoon, and good evening to all the esteemed participants for joining us from the globe. I am Premji Fufal, representing the NRI services of Ashutosh Financial Services Private Limited. I heartily welcome you all to our Zoom webinar focusing on the analysis on Union Budget 24-25 from income tax and investment viewpoint. It is a pleasure to have you all with us today as we delve into this critical topic that holds immense potential for financial growth and strategic planning for NRIs worldwide. This year marks our 19th consecutive public presentation on Union Budget, a testament to our commitment to keeping our community well informed and empowered to make sound financial decisions. Your continued support and participation have made instrumental in making these sessions a success, and we are excited to bring you another insightful discussion. As we all know, the Union Budget is a crucial financial event that outlines the economic priorities and policies of the Indian government. It affects every aspect of our lives, from income tax regulation to investment opportunities. Today, we gather to analyze the key highlights of the Union Budget 24-25 and explore how these changes will impact you. Our esteemed speakers for today's webinar are Mr. Daxesh Kothari, a distinguished tax and financial consultant and the MD and CEO of Ashutosh Financial Services Private Limited. Along with him, CA and CFP, Mr. Rajit Kothari, the Executive Director of Ashutosh Financial Services Private Limited. With their extensive expertise and experience, they will provide invaluable insights into the budget implications, guiding us through the various avenues for maximizing our financial growth and tax efficiency. Throughout the webinar, we encourage you to actively participate by answering the polls which will be asked during the presentation, posting your queries in the chat box, and engaging in the Q&A session at the end of the presentation. Your involvement is a key to make this session as interactive and beneficial as possible. Let us seize this opportunity to deepen our understanding of the Union Budget and uncover new strategies for enhancing our financial portfolios. Together, we can strengthen the bond between the global Indian community, fostering mutual growth and prosperity. We will begin with a short introductory video of today's speaker, followed by core presentation. Thank you for your presence and enthusiasm in exploring the Union Budget 24-25. Let's embark on this journey together to unlock the potential for growth and success. Thank you.
More than 65 years back, late Mr. Daxesh Kothari started a firm in the name of Messrs. Kothari and Company to provide tax and allied laws advisory services. Later, in the year 2001, the activities of the firm got expanded into a corporate entity in the form of Ashutosh Financial Services Private Limited. Over these years, the company has emerged as a prominent player in the field of financial services. The company operates with a quality management system certification of ISO 9001:2015 and is now a complete financial services solutions enterprise. Ashutosh Financial Services Private Limited is presently serving through its 4 different services, namely investment services, insurance services, NRI services, income tax and estate planning services. Investment services, which is in the activity of connecting people with investment opportunities for Indian markets. mutual funds for investing in equity, debt, and hybrid, portfolio management services for investing into equity shares, alternative investment funds for listed and unlisted equity shares, direct investment in shares of unlisted companies, investing in bonds, that is tax-free bonds, taxable bonds, and capital gain bonds, investing in fixed deposits of top-rated corporates, and investing in precious metal through sovereign gold bonds, for investing in global markets through mutual funds, direct investment in shares of foreign companies and ETFs, and precious metals through ETFs, insurance services providing insurance solutions for life insurance for life risk coverage, health insurance, mediclaim and personal accident, insurance of assets for all types of risks, insurance for liabilities, retirement and pension planning needs, and investment through insurance for guaranteed returns and ULIPs. NRI Services is a one-stop solution for NRIs to address their needs of investments in mutual funds, PMS, AIFs, unlisted stocks, and US equities, insurance for life risk, health, assets and liabilities, retirement planning, and investment through life insurance, complete planning and compliance for Indian income tax, advisory under FEMA and RBI regulations, estate planning for Indian assets, and complete support for compliance related to tax laws in the residence country with respect to Indian incomes and assets. Income tax and estate planning services works as advisory and compliance for income tax, estate planning, endowments and charities. Our company is a unique setup which is truly a one-stop solution for all the financial and taxation needs of the client. We enjoy state-of-the-art infrastructure facilities at prominent business locations across our offices in Rajkot, Ahmedabad as well as Mumbai, having designated setup for each service division to serve our clients in a meaningful manner. The company has a fine mix of personnel from financial and legal backgrounds like chartered accountants, lawyers, certified financial planner, and management graduates to form a dedicated team of skilled and qualified staff. The team works under the dynamic leadership of Mr. Daxesh Kothari, who is the MD and CEO, and Mr. Rajit Kothari, who is the Executive Director of the company. All the divisions and departments manage their operations with high-tech, versatile softwares, and the entire IT infrastructure is connected with integrated file server for seamless exchange of data with security and regular data backup facility. The company has a fully equipped conference room with projection and video conferencing facilities, which makes dissemination of knowledge, information, and interaction convenient. Our company website www.ashutoshfinserv.com and mobile app Ashutosh Finserv gives an overview of the happenings in the world of finance and is also a useful client user interface. We operate multiple investment management softwares for managing our clients' investments, having interface with our website and mobile app. With the help of our website, reporting software and app, our clients can carry out complete paperless investment transactions and can have access to their investment portfolios on real-time basis. We regularly update our clients with latest happenings from the world of finance and taxation through digital mode of interactions using YouTube videos, WhatsApp broadcasting, sharing the updates on social media, that is Facebook, Instagram and LinkedIn. The company has been conducting presentation on analysis of the union budget since last 17 years. It is also organizing series of presentations for non-resident Indians on aspects of taxation, regulations and investments since last 6 years. Similarly, Presentations which spread financial literacy across various groups in our society are regularly organized by our company, covering topics of vital importance related to finance, taxation, and estate planning. The company serves to more than 3,500 satisfied clients spread across the world and is actively maintaining business relations with many clients and groups for more than 65 years. Ashutosh Financial Services Private Limited is growing as a complete financial solutions enterprise with its presence felt not only in India but also globally. Mr. Daxesh Kothari is a tax and financial consultant and the managing director and CEO of Ashutosh Financial Services Private Limited, which is an ISO 9001:2015 certified company with prominent presence in the field of financial services. He specializes in the fields of income tax, FEMA, trust laws, estate planning, and foreign tax compliances. On the financial front, he specializes in investment services and insurance services. He advises companies, trusts, high net worth individuals, and non-resident Indians across the globe on financial and tax and allied laws related matters. He is a trustee of various charitable trusts. He has been involved with a number of social service projects of Rotary Club and is a Paul Harris Fellow of Rotary International. He has been presenting analysis on the Union budget since last 16 years and also on various subjects of taxation and finance at various forums addressing doctors, businessmen, industrialists, taxation consultants, chartered accountants, company secretaries, NRI and postgraduate students of diverse branches on subjects related to finance, taxation, and estate planning to make our society financially literate. His articles on financial subjects are regularly published in renowned newspapers like the Economic Times, Mint, etc., and also in magazines like The Lal Street. His interview was aired on ET Now as a mutual fund industry expert in the program named Swatantra, which is one of the most acclaimed investor education initiative of our country. He has also addressed a program dedicated to NRI on a leading Gujarati TV channel in Ahmedabad. He is a 360-degree versatile personality in the fields of taxation and finance, which makes him a unique and a truly a one-stop solution provider for a wide range of financial and tax-related matters. Mr. Rajit Kothari is the Executive Director of Ashutosh Financial Services Private Limited, which is an ISO 9001:2015 certified company with prominent presence in the field of financial services. He is a chartered accountant and a certified financial planner by qualification. Further, he has graduated in the field of commerce with specialization in banking, financial services, and insurance sector from Ahmedabad University and has also pursued post-graduation in the field of law. He started his journey with Ashutosh Financial Services Private Limited, where he played an instrumental role in functioning of several business development activities of the company. He also played a vital responsibility in the development of exotic product offerings for the company in the alternate investment arena such as foreign equity and unlisted stocks. Moreover, he was instrumental in the preparation of extensive knowledge database on different topics concerning taxation and finance for the company. Thereafter, he worked with Messrs. Deloitte Haskins & Sells LLP, one of the leading global consulting firms at Mumbai, focusing on tax and regulatory compliance for high net worth resident and non-resident individuals. He is an expressive public speaker and addresses professional forums on diverse topics related to finance as well as other topics of national importance. He has participated in international exchange program as a student, and has also attended management development programs across top business schools in India. As a young and dynamic director with a multi-skilled personality, he presently concentrates on exploring innovative business opportunities through geographical expansion, digital proliferation, and concentric diversification of the company.
Hello, everybody. The moment the union budget in India is to be presented, everybody in the country and all Indians, even outside the country, start looking at India as to what is going to be presented in the union budget and what is the finance minister going to talk in respect of the way the economy is moving. And I have been observing all these years that whatever kind of media interface somebody is into, maybe a newspaper, television, and in the modern times, the social media, everywhere the topic of discussion is the union budget. And today we are going to discuss about the union budget, but the way we are going to look at it is that we are going to look at the way the economy is as of now and what is that has been declared in the union budget in for the economy and in respect of the tax proposals. This reminds me of the times 33 years back. Why I'm talking and why I'm reminded of these times? For the reason that exactly 33 years back, in the year 1991, the then Finance Minister Dr. Manmohan Singh had presented his budget, and that was considered, and it is still considered, to be a landmark budget in the history of India. It changed the direction in the way the country was moving, and thereafter the country moved. In 1991, the time when Mr. Manmohan Singh presented the budget, India was in deep crisis. India had to send its 47 tons of gold to get just $405 million of foreign exchange, as the coffers of the country of foreign exchange were completely empty. And today, in the year 2024, it is a time when our economy is growing. The collections on direct and indirect taxes are quite robust. And last but not the least, one of the most important positives which the finance minister had this year was that it had got a hefty sum of dividend of 2,05,000 crores from the Reserve Bank of India by way of dividend. So this was a positive way in which the finance minister had started, and this is in sharp contrast 33 years back what the country was into. Before going to the proposals of the finance minister, which are put forward in her budget speech and the tax proposals, in order to understand and truly appreciate the way the budget is presented, we need to look at the way the Indian economy is as of now when the budget was presented. The first and foremost thing, the rate of growth. India is the fastest growing economy amongst the top 20 economies in the world. And undoubtedly, this is something which is acknowledged and accepted by all the financial institutions across the world, that this is going to be the trajectory in the times to come. As far as the inflation is concerned, India is in a position which is quite comparable to the rest of the world. I remember the times when inflation in India was to the extent of, say, 10% and plus, And in the Western world, especially in the US and UK, the inflation was just 1% or 2%. And there was a sharp contrast, and India suffered on account of this high rates of inflation. But that is not anymore. As far as the rates of interest are concerned, which is one of the most important factors when we look at the way the economy is as of now, if we compare the rates of interest between India and the balanced top 20 economies of the world, in the time span of 2 years, from the year 2022 to 2024, the change in the rate of interest which has happened in India is comparatively not that very sharp, while as in the Western world, the rate of interest, the rate at which the central banks lend to the banks, which we all know it as a repo rate, has gone up by at least 300%, which is impacting those economies. And when it is compared with India, the rates of interest have increased in the last 2 years, but the rate of change is not that very sharp. When we look at the way the Indian currency has been behaving, the rate of depreciation of the Indian currency vis-a-vis the US dollar is quite limited and calibrated. And if we compare it with, as I said, with the top 20 economies of the world, the rate is quite minimal and calibrated. If we look at the equation of the exchange rate between the Indian rupee and the US dollar from the year 2016 to the day the budget was presented, that is 23rd of July 2024, the CAGR depreciation of the Indian rupee has been just 2.80%. This is something which all the people who are observing India has acknowledged, that the rate of exchange between India and the balanced part of the world is quite calibrated and quite in a softer manner, which is against what it used to be in the earlier times. One of the important factors while shaping the budget for any finance minister in India is always the prices of Brent crude. The prices of Brent crude has been moving in the manner as it is as of now for one of the important reasons that there is a certain level of geopolitical crisis in the Middle East and in certain parts of Europe, as we all know. The price of crude, if it is in the band of around $75 to a barrel, it is quite calibrated. But whatever aberrations happen, the prices of crude oscillates. In the year 2020, on account of COVID and lack of demand, the price fell to around $40. And in the year 2022, on 30th of June 2022, the comparison which we have shown in the slide, the price of crude escalated on account of the war which started in Europe. Presently also, as I said, the price of crude is at an elevated level of $86, which is something which the finance minister had to take into consideration at the time of formulating the budget. The forex reserves of India is something which is an area of very strong satisfaction for everybody who is looking at India. The foreign exchange reserves of India are enough to cover at least 10 months of imports of India, and are to the extent that they are equal to 98% of the external debt which India is having. So the foreign exchange reserves are at extremely satisfactory situation, which gives a boost to any finance minister to plan so many of its policies in the times to come. When it comes to the investments in the stock markets, the foreign institutional investors who invest into stock markets globally have been present into India all these years. But when we look at the data of the FII investments in last around 4 years, the statistics says that the cumulative investment of foreign institutional investors from the year 2020 to 2024, which is around 4 years, and when we compare this investment with the investment of domestic institutional investors, which is the mutual funds and the insurance companies and other financial institutions which invest the Indian money in the Indian stock market, the Indian stock market investment in the Indian by the Indian institutions had been double than that what has been invested by the foreign institutional investors. This can give a lot of stability that if monies are withdrawn by the foreign institutional investors from the Indian stock markets, the Indian stock markets are not in that fragile state. And as the data suggests that in last 4 years, the extent of investment by the domestic institutional investors is double to that of the foreign institutional investors. That suggests that the Indians are extremely confident about their own country and the future of their economy. The GST collections in last 12 months have been quite encouraging. They are at an increasing trend. GST collections does not mean that this goods and services tax will add up to a lot of revenue for the government, but it is also important from the standpoint that it is an indication as to how the consumption and the way the economy is moving. These figures also provide a lot of support to any finance minister who is formulating the budget. And as a culmination of all these positives which I have been talking of, this is reflected in the way the Indian stock markets have been behaving. The Indian stock markets are amongst the best performing markets across the top 20 economies in the world as of now. Now, coming to the Union Budget 24-25, as we all know that the budget is a figure or gives figures as to how the finances of the government are supposed to be managed. It talks of the kinds of revenues which the government is envisaging to generate and the way it is planning to spend its revenues. So when we look a little deep down into the way the finances are expected to move, if we look at the tax revenues which we have marked in the slide before you, is that the tax revenues are expected to move up by at least 10%. This is something which is positive for the government, that they are able to see that the tax collection from the economy, which can be used for the betterment of the country, is at an increasing trend, and more people are getting included in the payment of taxes, and it is getting more and more inclusive. When it comes to the expenditure part, the kind of capital expenditure which is being planned by the government is also something which is very important. What we have marked in this slide before you is that from 9,48,000 crores of capital expenditure this year, of all the programs and everything which you read around, that this is a bridge, this is the infrastructure, this is the kind of monies which will be spent by the government, the total amount comes to more than 11 lakh crores. So the good feature is that more and more monies are being spent to create creditable assets in India, which can lead to a long-term growth of the country. And last but the most important part is that despite spending more on capital expenditure, on account of the way the things are planned, is that the fiscal deficit on this budget is expected to be declining from 5.6% to 4.9%. This is something which is in sharp contrast to the finances of various governments across the world are. So many of the governments which are big time economies of the world, they are facing a lot of crisis, and the fiscal deficits in those countries are on a rise. While as in comparison to that in India, the fiscal deficit is planned to be on a declining trend, which shows the strength of the way the government finances are. And this fiscal deficit is important because the more the fiscal deficit, there is a chance of more and more inflation in the country. Now, analyzing as to what has been provided in the budget in terms of figures, if we compare the direct taxes to GDP ratio, this is a ratio of what all direct taxes. By direct taxes, I would mean basically the income tax. In comparison to the kind of collections which are being planned or which have been recovered in the earlier years vis-a-vis the total gross domestic product of the country, they are at an increasing trend. Right from the year 21-22 to what has been budgeted in 24-25, the ratio of direct taxes to GDP is on a rise. In a country in which just 2% of the population pay income tax is getting more and more inclusive, more and more compliance is getting inculcated in so many of the people who have not been filing or who have not been fully filing their taxes with the government. The efficiency of the administration of taxes has led to this better direct taxes to GDP ratio. The defense expenditure on the way the armed forces or the preparedness of the army in the country is concerned is on a calibrated rise. But the fact is that now the policy is that indigenous production is going to be something which is going to be the thrust area for defense production. And if we understand or if we look at what is the kind of scope for the indigenous industry is, defense imports by India in last 5 years cumulatively have been to the extent of 1,94,000 crores. If proper indigenization happens and if we can plug these imports, then it could be a major opportunity, not just for the defense sector, but the manufacturing in India in general. There is a lot of scope for defense exports from India also. In the year 2023-24, to the extent of 21,000 crores has been the amount of exports of defense production which has been shipped out of India. When it comes to public sector undertakings, the public sector undertakings disinvestment has been looked at all these years. When we look at the budget, is something which the government would divest and try to meet its need for resources on capital or revenue expenditure. This was looked at like selling the family silver and meeting the needs of revenue, and at times even making certain capital expenditures in the economy. But now the policy and the way what has been provided in the budget this year is to be looked at. It is something which is very different. In the year 23-24, the year which has ended, the public sector undertaking disinvestment is at a very low level, which is the lowest level in last few years. But the way the market capitalization of all the 81 public sector undertakings which are listed on the stock exchange is considered, the market capitalization before 3 years was just 13 lakh crores across all the PSUs which are listed on the stock exchange. Today, the market capitalization is to the extent of whopping 73 lakh crores. So the policy of the government has been, rather than selling off the family jewels, to create value out of whatever assets the government is owning, and to see that all these public sector undertakings become profitable, efficient, and they derive a lot of value. And after that, the government might think of disinvesting it in a calibrated manner. Some of the announcements which have been in the union budget this year, one of the most important announcement is that the import duty on gold and silver has been reduced from 15% to 6%. And this led to a substantial fall in the domestic prices of gold and silver, which was a result of the 9% fall in the import duty of gold and silver. We understand that this is a measure to curb the illegal import of gold and silver in the country, to make it something which is not worthwhile for anybody to bring gold and silver into India in an illegal way. As far as the way the digitization is happening in the country, one of the most ambitious tasks which has been announced in the budget this year is that all the agricultural and urban land records are to be digitized. So all the records which are there in respect of land situated anywhere in the country are to be digitized, and a land registry of this digital records is planned to be built. This could take a bit of time because it is a marathon task, but whatever has happened in respect of the way Aadhaar has been a part of our life in India, this is not something which is quite far off. Stamp duty rates on transfer of immovable properties in India in certain states are on the high side. The government has announced, the central government in fact has announced that we will convince the state governments to moderate the rates of stamp duty and see that there are special lower rates for stamp duty for women in those respective states. The government has announced that in another 6 months' time, the Indian Income Tax Act 1961 is to be completely revamped, and a new direct taxes code is to be put forward for discussion with the stakeholders, and it would become something which would be a law where it would be one comprehensive law which would be quite simple and without lots of provisions and explanations which the present Indian Income Tax Act 1961 has undergone on account of the transition which has happened in all these 65 years. So the government has thought that now is the time to see that a new code is in place to take care of the future needs of direct taxes the way it should be governed in the times to come. Insolvency and bankruptcy code has been one of the most instrumental ways in which the banking system in India has got strength. Under this code, which has worked as a landmark legal tool for the banking system, the banking system has been able to collect 2,46,000 crores from defaulting borrowers, and this has acted as a strong deterrent for anybody who is planning to borrow from the banking system. So these were the certain highlights of the way the economy is, the way the finances of the country have been planned as far as what has been laid down in the union budget is concerned, and what are the announcements which have been made by the government on the aspects which are other than the Indian Income Tax Act. Now, in the second part of the presentation, Rajit Kothari will take up what has been the announcements or what has been laid down as to the changes under the Indian Income Tax Act.
Hello, everyone. It's a great opportunity every year to address all of you who are so enthusiastic and who have joined from practically the entire world in this important topic, which sets a milestone for the upcoming financial year and is on this important topic, which sets as a milestone for the entire financial year and sets the tone for every individual to plan their personal finances. Moving forward with today's presentation, I'll now take up the changes which are announced in the Income Tax Act, which is one of the major constituent of every budget. Starting with the personal taxation, in every budget, the government revises the personal tax slabs and announces different nitty-gritties relating to it. As we know that in India, currently there are two tax regimes. One is the old tax regime and the second is the new tax regime. Under the old tax regime, there have been no changes that have been announced in this union budget, and whatever are the rates that were prevailing are as it is, without any kind, with all the benefits in terms of the deductions that were available in the past. One important thing which we should note is that if there is any person in India who is filing their Indian income tax return and having incomes from the head of business or profession under the old regime, coming in the next few financial years, that person will not be able to change the regime of taxation and will have to mandatorily go with the old regime of taxation as long as it remains. The second is the new regime of taxation, which is now becoming the most popular means of filing tax returns in India, in which the rates are concessional, but the exemptions or reductions are not available to the maximum extent. There have been concessions which have been announced under this regime, which we can witness through this slide, in which there is a decrease in the rate of tax up to an income of about 10 lakhs of rupees. So even if a person has got incomes exceeding 10 lakhs of rupees, which could be anywhere, still that benefit would be available, since this is a progressive taxation and the benefits of these slabs of lower slabs of tax would be available to every taxpayer. As far as a resident individual is concerned, there is no income tax up to 7 lakhs of rupees, because this rebate of 25,000 rupees is available. Well, in case of non-residents, these are the rates at which the taxation would happen depending upon the level of income. Certain other changes in the limits that have been announced in this budget. The standard deduction that is available to salaried individuals has been increased from 50,000 to 75,000 rupees, which makes practically salary income up to 7,75,000 rupees tax-free in India. The popular exemption on long-term capital gains, which was available on equity mutual funds as well as equity shares, when the holding period of those assets exceeded 1 year, has been increased from 1 lakh to 1,25,000 rupees. This is along with the increase in the capital gains tax that has been announced to benefit the income earners in terms of the capital gain incomes. As far as the contribution to employees is concerned from the national pension schemes by the employers, the way it works is that this contribution made by the employer to the employee under the NPS, National Pension Scheme, is an income of that particular employee, and deduction up to 14% of the salary will now be available for this contribution to NPS, which was earlier only 10%. Even the family pension exemption has been revised from 15 to 25,000. Securities transaction tax, a tax which every individual has to bear or every institution has to bear, or any kind of transaction that happens relating to the stock market, has been increased for derivatives transactions, which is particularly futures and options. The regulator in India, which regulates the financial market, SEBI, is really concerned about the increasing amount of speculative activities that is happening in India, when the household savings are being diverted towards these kinds of activities, which is why the government has increased this STT to discourage these kinds of activities to the extent possible. A popular highlight of this budget is the increase in the capital gains tax, which affects a lot of people like us who are investing in either of the asset classes in India. This can be broken down into three parts: the change in the new, the new capital gains tax regime. The first is one which is for the assets which are invested into the listed space, the equity markets, the stock market. If we look at that, there has been a uniform holding period now of 12 months, which was also the case earlier. And what has been proposed from 23rd July in the budget is that there will be a uniform long-term capital gains of 12.5%, which is 2.5% higher than the earlier rate, and a short-term capital gains of 20% on certain kinds of investments, which was earlier 15%, and 20 on as per slab rates, which was the case earlier as well for few of the assets. Moving forward with the second part is the unlisted assets and practically all other capital assets that we can think of, which includes real estate as well as unlisted stocks, mutual funds, which are either debt based or certain kinds of hybrid based, or anything that we can think of. There were multiple different kinds of regimes in this, wherein the holding period to qualify as a long term or a short term was either 24 months or 36 months, depending upon the type of assets, which has been unified to 24 months now. And the long term capital gains for this kind of incomes have also been at par with the listed assets, which is at 12.5% for most of the assets. And the short-term capital gains have been intact, which is as per the slab rates of income. One thing which is important to note here is that the mutual funds, which are either investing into foreign equity or gold, or are of a certain other type, which are particularly hybrid in nature, this change will be effective from the next financial year. For this financial year, that is 24-25, as per the current proposals, they are to be taxed at the slab rates of income, irrespective of the holding period. The third type of categorization of capital gains that would now be prevailing in India would be for the debt funds, in which the underlying investments to the extent of 65% or more are into debt-based or money market instruments, which should be always taxed at the slab rates of incomes, no matter what is the holding period. Just to give a better idea and clarity about this change, we have illustrated few examples for certain kinds of assets as to what will be the tax implications had they been sold prior to the budget and what would happen if they are sold now. taking the first example, which is of a gold which was purchased prior to 1st April 2001, which was hypothetically assuming of 100 grams, the current sale value as per the market price prevailing as on the current rates for 100 grams would be about 7,14,000 rupees. One thing important to note in this change of capital gains tax regime is that the indexation benefit, which was allowed earlier, has now been taken away. So the cost, which whatever it is, will be allowed as a deduction. Had the property been purchased prior to 1/4/2001 for any other kind of capital asset, which is an unlisted asset, the fair market value as on 1st April 2001 will be the deemed cost. It would be simply reduced from the sale price without any kind of indexation benefit. Had these been sold prior to this date in which budget was announced, the indexation benefit would have been naturally available, which is why the fair market value as on 1st April 2001 as taken in this example was 4,190 rupees for 10 grams, and for 100 grams it would be 4,19,000 rupees in the left side of this slide. Now, to escalate it according to the inflation and as per the indexation which was earlier, it comes to 1,52,000 rupees roughly. So the gain would have been around 5,62,000 rupees, which is why the tax on that at the rate of 20% would have been 1,12,000 rupees. Now, what would happen is that, as I mentioned, the indexation benefit will not be available. So the sale value minus the fair market value as on 1st April 2001, because this property, this asset was purchased prior to 1st April 2001, would be simply reduced from the sale value, and whatever is the gain, which is about 6,72,000 rupees, would be taxable at 12.5%, which reduces the tax liability in this example. Moving forward with the second example, which is of a real estate property purchased in the financial year 2004-5, had this been sold prior to the budget, the indexation benefit on the purchase value, which is assumed to be 20 lakhs of rupees for the property, would have been available, which is why in this example, as we have mentioned and illustrated, this 20 lakhs would have been escalated to 64 lakhs of rupees at the prevailing indexes, whatever were there. Assuming the sale value to be 1 crore of rupees, the gains from this would have been 35 lakhs 75,000 odd, which is why the tax at the rate of 20% on that would have amounted to about 7,15,000 rupees. If this property is sold now at the rate of 1 crore rupees, the cost price, as I mentioned, would be available as a deduction at the same value, whatever is the actual cost without any indexation benefit, which would result into a gain of 80 lakh of rupees on which this concessional rate would be applicable and the tax liability would arise accordingly. So it depends upon case to case whether this change is beneficial or detrimental in terms of the increase in tax liability that comes into picture. A lot of debate, discussion has happened in the media on this change of capital gains. People have got different views, different thought processes on whether it is beneficial, not beneficial, so on and so forth. Certain perspectives which we have on this change that I want to highlight. First and the foremost is that no matter whatever has been the increase or increasing amount of taxation basically that has happened with this kind of a change, there has been a rationalization, uniformity and a simplification on the capital gains tax regime, which is something which we all have to accept. The earlier regime of capital gains was quite complex, wherein there were multiple rates, multiple holding periods for different kinds of asset classes. Even within the same asset class, within the same type of asset, there were multiple ways in which the tax had to be calculated. Now, this has resulted into a lot of clarity for the taxpayers and has built a uniformity which was required. Secondly, when we interact with individuals from practically the entire world, and I can see that there are so many participants from different developed economies like US, UK, so on and so forth, who have participated. You would agree to me that the rates of capital gains in those countries are much higher than what they are in India, even with this increase in the rate of capital gains tax. So one fact that we have to gracefully accept is that as and how the economy moves from a developing to a developed nation, there would be an increase in the rate of tax. And that is what the major nations of the world have now accepted and have moved on with that fact. So as we usher into this new era for the Indian economy, we have to accept this increase in the capital gains regime, which would happen over time. Third aspect is that there is a lot of unaccounted economy which happens especially in the real estate transactions in India, which many of you would be aware of. Now, had this been taxed at a rate of 20% and comparing it with the present rate of 12.5%, it gives a lot of incentive for taxpayers to declare and channelize whatever are the realizations of these properties into the formal economy, into the actual tax net, rather than keeping it unaccounted and converting it into official channel through some or the other means, which could result into much higher taxation and much bigger hassles in terms of managing that kind of an affair. So what would the idea or the objective of the government behind this is also to encourage the taxpayer to join this formal economy and declare and go for the official route of transacting, especially into real estate. Public equity is the stock markets in which all of us do invest and participate through the mutual funds or direct stocks. And own equity is the own ventures, own businesses, ideas of the entrepreneurs who start their own businesses. Till now, what happened was the taxation in the public equity was practically at the rate of 10%, which was a flat rate. And had someone started their own businesses in India, which could be a proprietorship, partnership, or a company, the tax rates on those incomes from those businesses would be as high as 30, 35, 39%. So there was a glaring difference when someone generates incomes through capital public equity, particularly through the gains in the stock market of a certain amount, and the gains what would be generated out of own equity by way of starting own business in the rate of tax. So this would probably result into people and youngsters like me to join the public equity rather than participating through own equity. So this is a means to encourage entrepreneurs to bring or reduce the disparity in this taxation between the two different avenues. This new tax regime has reduced the tax rates on the unlisted stocks or the startups to a flat rate of 12.5% at par with the listed equity with the same holding period, which was not the case earlier. The tax rates on the public equity through the listed space was concessional on the concessional side as compared to the unlisted space. So another idea of the government is also to encourage investments and bring in new capital into all these emerging businesses which have still not approached and reached that level of the capital markets. Taxing the high income earners, the idea of the government till now has always been to tax the high net worth individuals, income earners who are on the high tax bracket, and provide those benefits to the middle income earners as well as people who are in the challenge income era, in challenge income bracket. So a statistic of the government says that more than 60% of the capital gains tax is realized from tax filers who have got incomes more than 1 crore rupees. So this increase in capital gains would eventually help in attaining this objective of the government. One thing which we feel that could have been done in a different manner is retrospective taxation could have been avoided. To explain you this further, retrospective taxation means that this taxation has been applied backdated, meaning whatever is the unrealized gain into these kinds of capital assets that we have been increased by 2.5% for long term for everything right from inception, whatever has been the holding period. Unlike the change that was announced in 2018, wherein this 10% capital gains was introduced by the government, and there was a concept of grandfathering, wherein whatever are the valuations of the stocks or mutual funds as on 31st January 2018 were frozen, and the subsequent gains were then taxed at 10%. So if someone was of the view that this tax is something that they would not be able to accept, then they could have easily moved out of the capital markets in a tax-free manner, and the taxation would have been prospective, wherein this has been retrospective, which could have been avoided. Similar to that, even the indexation benefit, which was earlier available for all these years of the increase in the inflation, has been taken away. Even this could have been changed, wherein the values, the indexed values as on a particular date, let's hypothetically say 1st April 2024, would have been the benchmark, and the subsequent gains thereafter would have been taxed at 12.5% or whatever rate the government feels is necessary. Second important announcement or highlight of this budget was taxing the buyback of equity shares. So till now, what happened was that buyback of shares was a very popular event wherein the company could distribute the accumulated earnings or reserves to the shareholders and pay a concessional rate of 20%, and it was completely tax-free in the hands of the shareholders who received it. Vis-a-vis the route of dividends, wherein the dividends may not be taxable, distribution of dividends are now not taxed to the companies, but the dividends received by the shareholders are taxed at the slab rates of income, which could be quite high, up to 30-39%. So to reduce and to bring, to reduce the disparity between these two transactions, which are as such of the same nature, the government has now announced that whatever is the earning that the shareholder has out of this buyback would be taxed at the slab rates of income, just as it would happen in case of distribution of dividend. And whatever is the value of the shares that are bought back by the company from the shareholder would be allowed as a set-off against other capital gains to the shareholders. Meaning, if there are shares of a certain value which a shareholder gives back to the company under this buyback transaction, he can set off the gains, the losses, whatever is the value, against other capital gains income, or can carry forward it to the subsequent financial years to be set off against other incomes. And this would be applicable from the 1st October. So whatever are the buybacks in the coming 2 months would not attract this tax regime. The residents of who are tax residents of India, basically residents and ordinary residents, are required to disclose their global assets in the income tax return in the prescribed format. And if this is not done, then there is a penalty of 10 lakhs of rupees under the Black Money Act, which is now prevailing. This penalty was not applicable when the foreign undisclosed assets were not exceeding 5 lakhs of rupees. This has been increased to 20 lakhs of rupees from 5 lakhs of rupees. So practically what would happen now is, to the extent of 20 lakhs of rupees, when someone has got assets which are not exceeding 20 lakhs of rupees and does not disclose these foreign assets or foreign bank accounts, then there will be no penalties under the Black Money Act. There could be penalties under the income tax law, which are not as high as this, but this draconian penalty is not applicable to them. This provision is only applicable to resident taxpayers of India. TDS related changes which are announced: whenever there is a transaction of immovable property which happens, in which the seller is a resident individual, then there is a TDS provision of 1% on when the property value exceeds 50 lakhs of rupees. There are several scenarios in which there are multiple buyers or multiple sellers, and what was often interpreted by several buyers or sellers is that this 50 lakhs of rupees is something which has to be seen at an individual level for every buyer or seller. To clarify that, the government has announced that it is the entire transaction value of the immovable property which is to be considered rather than the individual value, whatever are the number of buyers and sellers. So there could be n number of buyers and n number of sellers, but if the valuation of the property, immovable property, exceeds 50 lakhs, then every buyer in the property has to deduct this TDS of 1% and pay the subsequent amount to the seller if the total property value exceeds 50 lakhs of rupees. Several TDS rates that have been reduced from 1st October, which is payment which is received for a life insurance policy or any commission or brokerage or certain kinds of rent which is exceeding 50,000 rupees and paid by an individual or HUF to the landlord, and several other personal consumption which is done for contractual work or professional service, commission, whatever, by individuals or HUFs who are not covered under the tax audit framework. For them, these rates have been reduced. TDS and TCS returns could be revised any number of times for correction or rectification. There is no kind of limit on the number of times it could be revised, but the time limit has now been announced by the government, which is 6 years from the end of the financial year. So if someone were to file their actual TDS return in this financial year, then the time limit for revising it would start from 31st of March 2025 up to a period of 6 years following that. A clarification which has been inserted is that whenever there is a professional fee or a technical fee that is paid by to any professional or any technical service provider, the TDS has to be at 10%, which people are aware of, but they are often interpreting it to be a work and deducting TDS under the other section, which has got a concessional rate of TDS deduction at 2%. So this should not be misinterpreted, and the actual TDS on any professional or technical fee should be done at 10% and not 2%. The assessments which are particularly for income escaping, which are very frequently encountered by certain taxpayers who have got a certain level of transactions incomes and who have not disclosed income in the appropriate manner, is income escaping assessment. So the time periods for issuing notices have been revised, wherein if the income that has escaped assessment is up to 50 lakhs of rupees, the time period has been increased from 3 years to 3 years and 3 months from the end of the relevant assessment year, which is there. And for cases when the income is exceeding 50 lakhs of rupees, the earlier time period was up to 10 years, which has been now reduced to 5 years and 3 months for issuing such notices. Certain changes that have been announced for the partnership firms. Wherever the partnership firm is now paying any kind of payment to the partner for any of these heads, which could be salary, remuneration, or even interest, commission, whatever, there has to be a TDS of 10% which is applicable. And this is not applicable when the amount of the payment is not exceeding 20,000, but in balance cases, it is always supposed to be applied. This is the extent of deduction which was earlier there, which the partnership firm could claim as a deduction for expenses whenever it is paying remuneration to its partners, which is calculated depending upon the kind of book profit that the partnership firm has. So that has been now increased. So a greater amount of deduction can be claimed by the partnership firm for paying interest to for paying remuneration to the partners. And one thing which we should note is that the partnership firm can pay any amount of interest that it wants to the partners, but this is the limit for allowance of the deduction under the Income Tax Act as an expense for this payment of remuneration. Few other announcements that have been made. there was a Vivad Se Vishwas scheme, which was quite popular a few years back, which the government could successfully roll and collect a lot of taxation to settle several pending litigations. It is announced that a similar scheme would be announced, and taxpayers could take benefit of that starting from 31st of December 2024 and settle whatever are the pending litigations. GIFT City, which is a very emerging global financial center which is now developing in Gujarat, has received greater options for introducing funds which have got tax exemptions. So there is an alternative investment fund structure which we had covered in one of the past webinar that we had organized, wherein there are tax exemptions which are available to investors. Now, these exemptions have been extended to even retail schemes and ETFs that are exchange traded funds, which could be announced, which could be rolled out by companies in the coming times. Whenever someone is claiming an expense under for the business or as a professional, and that expense is for the settlement of any kind of proceeding which was arising out of a contravention or not following a law which was in force, which is to give examples, fines or penalties, then this kind of expense will now not be allowed as a deduction. Charitable trusts were mandated to register themselves few years back in the budget that was announced, and they were to obtain a fresh registration and seek this kind of approval from the department to continue its existence. For if there are trusts who could not apply and re-register, then the department has given this leeway wherein they can request for a delay which has happened for whatever reason, and the income tax department can condone or accept this kind of a delay and extend the timeline for registration, and also for the ATG registration, which is also there, which the trusts have to obtain to have some kinds of benefits. A final quote by our Prime Minister is, India, as we know, is the land of reform, perform and transform. What we mean is that there are 3 steps in which the government is approaching to move forward. The first is by way of introduction of all these reforms which they have announced and they have been announcing since last decade, and executing those reforms whatever are announced, which is even more important. It is very easy to announce, but it is very difficult and equally difficult to execute that which the government has been doing, and that is what will transform the nation in the coming times and achieve all of our dreams to make India a developed nation from a developing nation. A disclaimer from our side that whatever were the views in this presentation were all personal, and there is no professional advice that we intend to provide through this means. A glimpse of our upcoming corporate house, which is coming up. And if any one of you happens to visit Mumbai, Ahmedabad or Rajkot, it would be our pleasure to meet you in person and to work with you for all these services which we have when it comes to investments, insurance, NRIs, income tax. We are a one-stop solution for any and every kind of thing that someone could think as far as India is concerned. Before ending and moving forward with the questions, I would like to ask a question which we would now exercise through a poll. We want your feedback from the outcome of this union budget, and what according to you would be the outcome on the stock market per se. I think most of you would be investors into the stock market through mutual funds or direct stocks or whatsoever. So this is something which we would really like to know your feedback about. We have given 3 options for clarity, which one is the positive outcome, which will continue the trend that has been observed. Second is the negative. There could be some detrimental signals which you think could be announced, and third is a neutral stand, wherein there won't be anything sharp in either of the directions. I think we'll wait for a minute more before we have the results and we go for ending the poll. Yeah, let's have the results. Can you share the results? So most of the participants, more than 65%, have voted for a positive outcome, which is in accordance with our thinking as well and resonates very well with the kind of movement that the stock market has started witnessing. And for obvious reasons, as we are all aware about the prudent policy that the government has announced, which we understood through the budget, which is fiscal consolidation, reducing the fiscal deficit year on year, which could have far-reaching implications, and naturally continuing with the trajectory of infrastructure development, manufacturing development, holistic development across different sectors, along with being savvy on the taxation front and announcing whatever is something which is required and good, healthy for the economy, rather than something which is appeasing to the taxpayers. Thank you so much to everyone for participating and joining in this knowledge sharing initiative of ours. And we would now like to move forward with the question answer session.
Yes, thank you, Rajit bhai, for this wonderful insight on the union budget. We can unmute Mr. Ramesh Vibhakar. So he is having some query with regards to the taxation on the immovable property. So kindly please unmute Mr. Ramesh Vibhakar.
Hello, can you hear me?
Yes, very much, Amesh. Hello,
Hi,
how are you?
Good, thanks. Good afternoon from a sunny Riyadh. How are you, Rajit?
All good, thank you.
Great. Lovely presentation and really enjoyed understanding that.
Thank you.
A quick question I had was on the property taxation, and the thing that, because I'm undergoing a similar situation currently. So just wanted to understand that when you consider the cost of the registered value during on the sale deed, would you also be considering the cost of the stamp paper and the registration fee paid at that given time, or would it be only the registered value of the property? When taxation?
Okay. I think this has come up from a statement made by the Revenue Secretary. But the fact remains that there has been no amendment in the settled law. The settled law and the several pronouncements of various high courts say that whatever is the cost of acquisition and the cost relating to the transfers, that does not just include the stamp duty, but the brokerages and every other kind of expenses to acquire the property are considered to be the cost of the property. So that is something which could be his interpretation of things. But as I said, there has been no change in the position of law, and whatever has been interpreted by the courts as of now, it stands like that. So we need not worry about that this stamp duty which has been paid would not be allowed. In our view, it would be allowed, and it is still a part of the cost of acquisition of the property.
Great, that clarifies a lot. Thank you very much.
Thank
Pleasure.
you.
I request to the participant, if anybody is having any doubt or any question on which they wish to have the live interaction with today's speaker, we can ask to the speaker. Well, I think no more questions are coming out there, so maybe we can proceed further to end the session.
We thought that the way the capital gains have been structured, is quite complex, but I think the participants are quite clear as to the way the implications and the way the operations of the capital gains is going to happen. And that is really, that's really good to observe.
I think in the back end they have kept Ashutosh Financial Services to guide them on point to point, on time to time, and to take care of their required compliances to be taken care in India. So, couple of questions are there on the chat box. One from Mr. Rajesh Rajan. Will be indexation rate be still available irrespective of they being removed? I think it is related to whether indexation is available or not.
So as such, it has been clearly proposed in the budget that the indexation benefit which was available is no longer going to be available. And if the capital asset was acquired prior to 1/4/2001, any kind of unlisted asset or a physical asset, which could be gold or real estate, then the fair market value as on 1st April 2001 is going to be the deemed cost without indexation benefit, and that will be reduced from the sale consideration to arrive at the new capital gains, which would be applied at the rates which are now changed.
Right. And one more question is there on the chat box by Mr. Vibhakar, that is that the market is moving positively, is growing positively, but despite of increasing the tax. So I think he is in doubt that if it is really going to be in that way, or will there be any negative effect there maybe in future?
The way we think is that, say, a 2.5% increase in long-term capital gains tax is not something which can, make somebody think that this is not the place, or this is not the economy, or this is not the market in which somebody should be investing into. So at the end of the day, whatever is the taxes which is being collected, it is going to be channelized for something which is going to be a part of the government's receipts. Maybe it could hurt somebody who's investing in the stock market, which is quite understandable, but a 2.5% increase does not change the approach and the trajectory of the stock market. This is the way we hold a view on it.
Okay, thank you. Now, so many questions are coming up there on the chat box. So one question is there by Mr. Ajit Kumar Jain, and that is with regards to NPS, investments in NPS. So earlier there was a reduction available of 50,000. So it is going to be continued for the same, other than for the salary class people like retired one.
The deduction which was there for 50,000 rupees is as it is. It would still be available. There is no change with respect to that. The only change is with respect to the contributions made by employers of employees for the NPS, and which the limits have been increased to avail a greater deduction.
Okay. Few more questions like how easy is to open an LLC in India? What are the website I should refer to have more information? Okay, with regards to LLC, setting up an LLC in India.
As far as a limited liability business vehicle in India is concerned, there are two different modes, which is a limited liability partnership and a private limited company, which can be explored depending upon the facts and circumstances of the case. And they are very much possible now with the ease of doing business that has now developed in the last few years in India. They can be set up within few days online, just a few documentation that is required in the prescribed format. And a lot of people across the globe have been doing that.
Okay. Mr. Nimesh Patel wants to know the gift tax-free option available in Gujarat and the minimum ticket size of that option. So if you can just give a little bit highlight on it.
A very popular means which has now been emerging in India for tax-free investments is through the GIFT City route. There are funds which have been set up in the GIFT City, which is the Gujarat International Financial Tax City, which is an emerging global financial center, just as Singapore, Dubai, Hong Kong, something like that. And all the investments that are done into these funds, which are set up in GIFT City, registered in GIFT City, are then invested into the Indian capital markets, which is the Indian stock market through or Indian mutual funds, which invest into Indian stock market. But the end result and investment of those funds would be the Indian stock market. What happens is that the taxes on these kinds of appreciations, whatever happen for the investments routed through these AIFs in GIFT City, are completely tax-free in India. So there is no incidence of tax as far as India is concerned. Also, there is no requirement of opening a separate demat account or a bank account in India whenever someone wants to exercise this option. The present ticket size of investing as per the regulatory requirements is 150,000 US dollars, which can also be staggered up to a period of 1 year, but that is the minimum commitment which is required as of now.
Okay. Mr. Lalani, Piyush Lalani, Mr. Feroz Lalani wish to know about the impact on the double taxation, like since the increase is there on the capital gain tax. So what will be the impact on the double tax avoidance agreement, or how they were like before they were claiming the exemption? Would they be continue doing that there in their home country?
As far as the double taxation avoidance agreements are concerned, there have been no material changes. So whatever are the taxes that are paid in India may be at 10%, which was the earlier case, and now 12.5% for listed assets, and also for unlisted assets, which was at 20% with indexation earlier, which is now at a lesser rate of 12.5%, is something that the non-resident Indian can take a credit of if they are tax residents of that particular countries, those particular jurisdictions, under the double taxation avoidance agreements. So the amount of credit could either increase or even decrease if that is the case, for which could be availed. But otherwise, as far as the entire structure of things are concerned, there is no change which would happen.
Okay. Now, one more question from Mr. Dinesh Patel. He wishes to know the effective date of the applicability of the new rates of LTCG. It is from 1st of April or it's from 23rd of July 2024.
All the gains that arise out of from 23rd July onwards will be taxed at this rate, and the gains that have arisen prior to that, from 1st of April to 22nd of July, would be taxed at the erstwhile rates. So whatever are the sales that happen of capital assets from 23rd July and onwards would be taxed at the new rates.
Okay, so maybe we'll take the last question from the chat box. That is by Mr. Piyush Hirapara, and he's asking that if the taxation such as LTCG going to be on the upside trajectory and applied retrospectively, does it make sense to square off portfolio now and reinvest again to limit taxation exposure to current level for profit earned so far long term are concerned? So he is planning to invest for a long-term horizon of 10 years or more, maybe.
Right. So as such, whatever are the unrealized gains on the portfolio value have now been will now be subjected to an increased rate of 12.5%. So this increase has been made effective for everything that is even unrealized. So if someone does this kind of a planning wherein someone sells off, squares off the position, and again invests into any of the asset classes, then it would not make any difference as such, because the rate of tax is something that has been crystallized now at 12.5%. And even the subsequent gains that would arise out of squaring off of this position reinvesting would be taxable at the new rate. So either ways, the person is in the neutral stand, and it may not make much sense to do this kind of a working.
Just to add to that, say, let us assume that there could be some changes in times to come uh, in respect of the taxation which could get increased. So if you square up the portfolio, say today you are generating a profit of 100, out of which you would be paying off, say, 12 and a half by way of taxes. So you will be able to reinvest only 87 and a half out of the amounts which would be the profits. So your investment into the next cycle is going to be only 87 and a half. So that could be a disadvantage. So if the rate of tax remains the same, or even if, say, it marginally increases, your investment would not be paying off the taxes. So the deferment of taxes and that deferred amount of tax remaining invested might take care of that in the increased rate of taxation even. So booking profits just for the purpose of safeguarding yourself from future tax increases might not something which might be a great idea.
Right. So one more question is there by Mr. Rajan. It is with regards to the registration of the sale deed of the property and preparation of the sale deed. So will the new tax regime is applicable on the sale deed, the date of the sale deed, which or when it has been prepared, or it is applicable when the property has been actually registered in the sub-registrar?
As such, the date on which the document is registered is the date on which the sale is effective. So if the registration of the document had happened prior to 23rd of July, the old rates, which were the erstwhile rates with the indexation, would be applicable. And if the registration would happen from 23rd July and onwards, it would be at the new rates and the new regime.
Okay. So now participants have started to take active participation in the for the interaction with the speaker. So we have one more question by Mrs. Parivisha Mehta. That is with regard to investments in Gift City of 150,000 is the ticket size, which is compulsory. But she wished to know that the returns which are expected after that 1 year time of investments.
So these investments, as I mentioned, into the Gift City are as such into the Indian equity market. So the underlying investments are into the Indian stock market. Gift City is just a means to attain a arbitrage in terms of the tax advantage and the operational hassles which go around starting investments in India. So if someone is starting with this investments of 150,000 into $150,000 into the funds established in the Gift Cities, the underlying investments would be either the mutual fund schemes into the equity stock markets, or they could be direct stocks of which are listed on the market. So the returns of that would be akin to what are the returns which are generated from our active managed portfolio in India, which are in the band of 12 to 15% on a compounded basis, considering the summation of the GDP growth rate of 7 to 8%, inflation of 4 to 5%, and another outperformance of about 2 to 3%, which is the rate anticipated of the earnings of these companies where the funds would be ultimately investing. And that earnings growth would be at least equal to the growth of the appreciation of the stock prices. So that is a return which can be very conservatively estimated and across a period of 4 to 5 years on a compounded basis. And that it is something which we can expect from these investments as well. One thing to note here is that there is no exit load which is involved in these kinds of investments, and it is an open-ended structure, meaning when this investment is done into these funds, which are through the Gift City, it would be at the prevailing NAV, whatever is there of those funds, just as we do for the mutual funds which invest into the equity markets. And the units would be allocated depending upon the NAV, and they can be sold and bought at any point of time without any minimum threshold, without any kind of exit loads which are there, but that is the minimum commitment and minimum amount that the investor has to invest as far as this route is concerned.
Okay, so there is one more question there in the chat box, but unfortunately I am unable to understand it. So I have asked Mr. Jain to please elaborate on it. If required, Mr. Jain, we can unmute you and maybe you can have the live interaction with the speakers.
Hello, good evening.
Good evening, Mr. Jain.
Actually, I just wanted to know whether this scheme ETF is available for Indian citizens as well or only for NRIs, because this fund you mentioned, it is in dollar, $150,000. Is it available for lesser amount and for Indian citizen as well or not?
This route of gift city investments is presently available to non-residents who are practically outside India and non-residents under the Income Tax Act. So meaning if they are substantially for a period of, I mean, they are outside India for a substantial period of time during the financial year, they qualify to be non-residents, and this investment route is available for them. It is not available for residents of India as of now, meaning people like us who are predominantly residing in India. Now, it is also available to non-residents who are not of Indian origin. So if there is someone who does not have any kind of connect with India, but is a non-resident who is outside India for a substantial period of time, that person can also avail this kind of investment benefit.
So the tax liability will be same as our other ETFs, equity
Right.
market?
So, if someone is a non-resident who is outside India, as I mentioned, they can take benefit of this kind of an investment, and the tax liability would be something which has to be looked only in the home country, the residence country of that taxpayer. As far as India is concerned, there will be no taxation as if the investments are through this AIFs which are structured in the gift city. This is a special concession, special tax benefit which has been given by the government to encourage investments from outside India into the Indian markets. So there is no taxation in India. Whatever is the tax rates and law that is applicable in the residence country where that particular person is residing is something which has to be dealt with.
Thank you so much for the clarification. But last but not the least, that whether this will have impact on our Indian stock market as well, because they will be investing in the same companies, equity shares and all. So will this have FII sort of thing impact on our market?
The markets in India would expand, and that is what is being envisaged. Because if we are looking at that, the Indian economy is going to grow, then there has to be a lot of investment that has to come to India into every other sector. So then they will require a lot of investment. So these are one of the routes which are being opened up by the Indian government so that more and more monies get channelized in the Indian stock markets. And when it comes to the levels as to, that it would be, there would be a lot of liquidity driving, monies coming from through this means as well. The way the entire trajectory which is expected to happen is that there will be a lot of companies who would be tapping in the times to come the Indian equity market. So a lot of liquidity which is going to come from different sources will get absorbed by this additional access by these companies which they want to raise money and to be invested in the country.
Okay, thank you. Thank you so much.
Welcome.
So I believe we'll take the last question from the chat box, and that is by Mr. Lalani. He is based out in Canada, so he wished to know that if he divests his equity exposure in India and reinvests through the gift city option, so will there be any tax advantage he will be getting from India by these investments?
Yes, absolutely. So what would happen is that whatever are the tax liabilities as on date from the unrealized gains out of appreciation into his portfolio would be something which will have to be borne, and at the prevailing rate of 12.5%, assuming these assets are long term. Once that is settled, then whatever is the balance amount that is reinvested, that will have to be, that if done through the gift city route, will not have any kind of further tax implications on the subsequent appreciation that would happen because of this special benefit that is announced. So if the investments are then channelized through this gift city route, then there is no tax consequence which he will have to bear in future for the further investments. And whatever are the taxes in Canada, that is something which can be then looked after.
Okay, so I think so participants, is anybody else wish to have the interaction, or if, are there any further questions? So I think we can now, we have come to the end of the session. So I pass on the, I request Mr. Daxesh Kothari and Rajit Kothari to uh, pass the ending comments on this session. Thanks.
So a big thank you to everybody for taking interest into this presentation and taking interest in India, and sparing your valuable time on this weekend. Thank you so much. Thank you to everybody.
Thank you, everyone. It was a great opportunity to address everyone, and especially the enthusiasm that everyone showed by way of interacting, posting questions was amazing. We look forward to continue having this kind of sessions for different kinds of topics that could arise and that could help you enrich your journey into Indian financial affairs.